Good afternoon, this is Sean Golding with Golding & Golding, here to do a relatively quick summary about the reporting and taxation of certain types of foreign investments for IRS Form 1040 and international information reporting purposes. There are a ton of different types of investments that may need to go on your annual tax return. Let's just focus on three common ones. Before we get there, first, it's important to note who has to report. A lot of times we will talk to people and it'll turn out they might have been an NR non-resident for the first year. Maybe they came here on a visa, but they only came here in October, November, and they filed a 1040 even though it wasn't required because they didn't meet the substantial presence test. For most of these types of reporting, it's only required if you're a U.S. person. If you're not a U.S. person, you don't have to do it, so you want to be cautious. Three main categories of individual, and as a side note, we're focusing on individuals, right? They're domestic entities, foreign entities, not for purposes of this presentation. Three types of individuals who are typically considered U.S. persons for tax purposes: U.S. citizens, lawful permanent residents, foreign nationals who meet the substantial presence test. If you fall into any one of these three categories, then you're considered a U.S. person for tax purposes unless an exception to substantial presence or possibly a treaty election to be treated as a foreign person for tax purposes may apply. If you are a U.S. person for tax purposes, you are taxed on your worldwide income. It's otherwise referred to as citizenship-based taxation. This is different than how most other countries do it, where it's called residence-based taxation, in which you're only taxed on your worldwide income in that country if you live there for more than 183 days and are considered a permanent resident of that country for tax purposes. Three types of investments that are common when preparing a U.S. tax return. The first one is foreign pension, foreign retirement, whether it's employment-born, whether it's individual investment plan. 99% of the time, it's reportable. There was some bad IRS information that was out there or inaccurate, in which it makes it sound like foreign accounts located in foreign pensions are not reportable. But what they were saying was it's for U.S. type of investment. So if you have a 401k and you have some foreign stock in there, you have a 403b or something equivalent in IRA, then generally if you have a U.S.-based qualified plan that has foreign investments in it, then you don't have to start parsing it out on the FBAR and reporting the income separately as foreign income. That's different than if you have a foreign pension, such as a CPF, an EPF, a SIP in the UK, superannuation in Australia, any provident fund in any country, primarily Asian countries, etc., etc. Depending on whether there is a treaty or not, so step back for 1 second. From a reporting standpoint, they're typically all reported on the FBAR Form 8938. For Form 3520, which is typically more complicated, you may qualify for Revenue Procedure 2020-17, which means you don't necessarily have to report it for 3520, the pension, if it meets certain requirements, but that doesn't necessarily apply to other forms. That Revenue 2020-17 absolutely does not apply to FBAR. In fact, so you would still report it on the FBAR and Form 8938. And then there are specific procedures depending on, which country. For example, I think it's 2014-55 is specifically geared toward Canada and excludes having to file certain like RISPs and RIFs and things like that on Form 3520, 3520A as a trust. Excuse me. Another type of investment that's very common is foreign rental income. A common issue we see here: someone's in a foreign country, they gross $20,000 worth of rental income in a year, but they have $30,000 worth of expenses. They go, I don't need to report that because it net a loss. Doesn't work that way for U.S. tax purposes. For U.S. tax purposes, you file Schedule E, you report all of the income, and you report all of the expenses. A few differences. Some countries don't have depreciation. In the U.S., you could typically depreciate the structure, which might help depending on where you fall in terms of taxes. Unfortunately, that depreciation goes back into the equation when you sell the property, so you want to look at the pros and the cons. Foreign countries may have types of deductions that are different than you may find here, but typically you can still take those deductions as long as they're legitimate. If the IRS was to challenge you and you lost, then you would just have to remove that deduction. It's nothing nefarious, it's nothing unethical as long as it's a legitimate expense. In a lot of foreign countries, for example, you don't get receipts and things the same way that you do here. So it just may not be viable. Doesn't mean you shouldn't include it if it's legitimate. And then the big one that we see a lot, foreign mutual funds, investment funds, ETFs, things of that nature. Unlike foreign stock, U.S. stock, or domestic mutual funds, which are all treated as you would imagine they would be treated, long-term capital gain, short-term capital gain, dividends, and qualified dividends, foreign mutual funds, and ETFs are considered PFICs, passive foreign investment companies. And there are some exceptions. Sometimes, if it's like a mirror fund and an insurance company may not meet all the technical requirements, and you could benefit from that because you don't want it to be a PFIC. If it's a PFIC, not only does it go on the FBAR, but it also goes on Form 8621. It may go on Form 8938 as well, especially in a situation where you have an account. That account has lots of different items in it, like a DMAT account in India. You may have stock, you may have mutual funds, you may have cash, bonds, etc., etc. Even in that situation, that account's going to go in the 8938, but you have to parse out the PFICs on Form 8621 unless an exception applies, depending on the value and whether there's excess distributions. Another thing to keep in mind is different countries have different wrappers in terms of how they wrap the investment. Like a lot of times you'll see an insurance policy or a self-invested type of pension plan, not employment-born. Those are not necessarily going to be treated the same as their like employment-born counterparts. So like let's say the UK, right? If you have a pension in the UK through employment, that may be treated than if you have a personal pension that's just a couple of funds that you invested in Aviva or something similar, legal in general, that wasn't created through your employer. When you have these type of investments, there are different types of forms that you need to file. We have lots of other presentations on that, but just to go over it briefly, the main form you have is the FBAR, Foreign Bank and Financial Account Reporting, bank accounts, investment accounts, stock accounts, mutual fund accounts, pension plans, life insurance policies, where there's a surrender value and other stuff as well. Depending on whether you live in the U.S. or abroad, if you live abroad, the IRS is going to say that you have to still file the FBAR, even if you make a treaty election to be treated as a foreign person. You could find that in publication 5569. There's a recent case, ROS Day, in which the court said, if you qualify under a treaty election to be treated as a foreign person for tax purposes, you can sidestep having to do the FBAR. That case is still in litigation at the time of this presentation. You may have to do Form 8938, which is similar to the FBAR, a little bit different. It's more expansive. So like, for example, you may have a stock that you own individually, security. It's not in an account, so it won't go on the FBAR, but it would still go on FATCA Form 8938. The main difference being, for Form 8938 FATCA, you have to have an interest in the account, whereas for FBAR, you don't. FBAR, if you have signature authority, you would still report it. For Form 8938, if you don't have any interest in the account, then typically you can avoid having to report it. Other forms as well, 3520, 3520A for gifts and trusts, 5471 for foreign corporation reporting, 8621 for the PFICs. Depending on whether you are a resident or not and whether you qualify for a treaty election or other type of exception, you may be able to opt out of having to do some of the reporting. But the IRS wants you to do the reporting, so it's something to keep in the back of your mind. If you're on a kind of wobbly ground in terms of whether you qualify or not, sometimes it's better just to report, especially if you qualify for certain disclosure programs like streamlined foreign offshore procedures, where you get into compliance, you can file original returns, and there's no penalty. For taxpayers who are out of compliance for prior years, there are various different amnesty programs that you can submit to. VDP, the Voluntary Disclosure Program, is now for both domestic and offshore ever since they merged OVDP back into VDP. I think it was back in 2018. And that's for people who are willful. If you're non-willful, there's various other programs. There's delinquency procedures, delinquent FBAR, streamlined filing compliance procedures, domestic if you're a U.S. resident, and foreign if you're a foreign resident. There's also a reasonable cause if you qualify. We have a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.